Welcome to Make Money with Finance Frontier AI, where we bring you the latest in actionable financial strategies to help you navigate the markets and maximize your profits. Today's episode is titled Finance Frontier AI Make Money, High Growth Stocks, Strategic Trades, and Defensive Investments, and we're coming to you from the heart of the financial world, New York City. Imagine this: you're sitting in the luxurious lobby of the Pierre, a five-star hotel with an elegant blend of old-world charm and modern luxury. As you sip your coffee, you gaze out over Central Park, the morning sun casting a golden hue over the city. Just a few blocks away, the towering skyscrapers of Wall Street stand as a testament to the bustling financial activity that defines this city.
That's right. The energy here is undeniable. New York City truly is the city that never sleeps, and neither do the markets. Whether it's the buzz of traders at the New York Stock Exchange, the strategic decisions being made at the Federal Reserve, or the endless flow of information between global financial institutions, every corner of this city is alive with the pulse of global finance. From our vantage point here at the Pierre, we can almost feel the heartbeat of the financial world. This city is where fortunes are made and lost, where every decision can have a ripple effect across the globe. And today, we're tapping into that energy to bring you insights that can help you make your next big financial move.
As we look out over this iconic skyline, it's a reminder that the markets, much like this city, are ever-changing, full of opportunities for those who know where to look. In today's episode, we're diving into some of the most exciting opportunities and strategies that 2024 has to offer. We'll be breaking down the stocks that are making headlines and showing you how to position yourself for maximum gains in the months ahead. If you've been following the news, you know that companies like Innodata Incorporated, INOD, and California Nanotechnologies Corp, CANOF, CNO, are showing strong potential, and we'll explore how you can capitalize on their growth.
But that's not all. We're also going to take you through some powerful swing trading techniques that can help you make the most of short-term market movements. These strategies are designed to boost your returns and minimize risk, giving you the tools you need to navigate the volatility of today's market. And let's not forget about the sectors that are primed for growth, like infrastructure, real estate, gold, and volatility products. These are areas with massive potential, and we'll discuss the key players and investment opportunities you should be aware of.
To round out the episode, we'll be diving into some defensive investment strategies and innovative trading techniques that are crucial for building a resilient portfolio in 2024. Whether you're an experienced investor or just starting out, this episode is packed with actionable insights that you can apply right away. So whether you're here to discover the next big stock, learn how to build a more resilient portfolio, or get inspired by the latest business innovations, you're in the right place. By the end of this episode, you'll be equipped with the insights and strategies you need to make smart, informed decisions in the year ahead.
Stay with us as we navigate through these opportunities, uncover the trends that matter, and provide you with the actionable insights you need to succeed in 2024. Let's dive in. All right, let's kick things off with some practical trading strategies that can help you capitalize on the opportunities in today's market. One of the key areas we're focusing on is small-cap stocks, specifically Innodata Incorporated, INOD, and California Nanotechnologies Corp, CANOF, CNO. These companies have been making waves recently, and there's a lot of potential here for savvy investors.
Let's start with Innodata Incorporated, INOD. This company has been gaining attention due to its strong positioning in the data and AI services sector. They provide digital transformation and data solutions that are increasingly in demand as companies across various industries look to leverage big data and AI. Innodata's recent earnings reports have shown solid growth, and their expanding client base is a positive indicator for future revenue streams. For traders, this presents an opportunity to buy into a growth stock that could see significant appreciation as the demand for AI and data solutions continues to rise.
Absolutely. When trading a stock like INOD, one strategy to consider is swing trading. Given the stock's recent volatility, swing trading could allow you to capture gains during short-term price fluctuations. By using technical indicators like the RSI, Relative Strength Index, and moving averages, you can identify entry and exit points that maximize your profit potential. For instance, buying on oversold conditions and selling when the stock reaches overbought levels could be a profitable approach. And for those looking to manage risk, setting stop-loss orders just below recent support levels can help protect your capital in case the trade doesn't go as planned.
Next up, let's talk about California Nanotechnologies Corp, CANOF, CNO. This company is at the forefront of nanotechnology, particularly in materials science. They're developing innovative solutions that could have significant applications across industries like aerospace, automotive, and healthcare. While it's still a small player, the potential for growth is substantial, especially as the demand for advanced materials continues to rise. For investors with a higher risk tolerance, CANOF offers an intriguing opportunity to get in early on a company that could be poised for substantial growth.
That's right. But with small-cap stocks like CANOF, it's crucial to manage risk carefully. One way to do this is by hedging your positions with volatility products like VIX options or the UVXY ETF. These instruments can help offset potential losses in your small-cap positions by gaining value when market volatility increases. For example, if you expect some turbulence in the broader market, you might consider buying VIX call options as a hedge against your long positions in stocks like CANOF. This way, if the market does turn south, the gains from your volatility hedge can help cushion the impact on your portfolio.
And let's not forget about the broader market indicators that can guide your trading decisions. Right now, the yield curve is inverted, which historically signals a potential recession. Sentiment is mixed, with rising caution, and the Nasdaq has recently tested its 200-day EMA, suggesting potential weakness ahead. Insider trading activity has shown increased selling, which could be a red flag. However, liquidity conditions remain strong, which is a positive sign for the market overall. Understanding these indicators can help you make more informed decisions about when to enter and exit trades.
To sum it up, small-cap stocks like Innodata and California Nanotechnologies offer compelling opportunities, but they require a strategic approach. By using swing trading techniques, managing risk with volatility hedges, and staying attuned to broader market indicators, you can position yourself to take advantage of these opportunities while protecting your downside. Coming up next, we'll explore broader investment opportunities in sectors that are set to thrive in the current economic environment, so stay tuned.
In our next segment, we're going to explore some of the most promising investment opportunities in the current market, focusing on sectors that are gaining traction and showing resilience in uncertain times. Specifically, we'll dive into infrastructure, real estate, and gold, three areas that have been garnering attention due to their potential for steady returns and growth.
Let's start with infrastructure. With the ongoing discussions around government spending and the push for modernization, infrastructure investments are looking increasingly attractive. The sector benefits from long-term government contracts and the essential nature of its services, which means that even in economic downturns, infrastructure companies tend to maintain steady cash flows. One strategy for capitalizing on this trend is to invest in infrastructure-focused ETFs, which offer exposure to a basket of companies involved in everything from construction to utilities. These ETFs provide a diversified way to benefit from the overall growth in the sector while mitigating some of the risks associated with individual stock picks.
That's a great point. And when we talk about infrastructure, we can't overlook the role of real estate, particularly real estate investment trusts or REITs. REITs have traditionally been a reliable source of income through dividends, and they often perform well when interest rates are stable or declining. Given the current economic environment, where we're seeing strong liquidity and relatively low stress in credit spreads, REITs focused on commercial properties, especially those involved in warehousing and logistics, could see substantial growth. With e-commerce continuing to expand, the demand for warehouse space is only going to increase, making this a sector worth watching closely.
Absolutely. And speaking of safe haven assets, gold continues to be a top choice for investors looking to hedge against inflation and market volatility. The Buffett indicator is currently signaling that the market is significantly overvalued, and the Shiller P/E ratio is also at historically high levels, indicating that we might be due for a correction. In such an environment, gold becomes even more appealing as a way to preserve wealth. You can invest in gold through physical bullion, gold ETFs like GLD, or even gold mining stocks, which offer leverage to the price of gold. Each of these options provides a different risk-reward profile, so it's important to choose the one that aligns with your investment strategy.
And let's not forget about the role of market indicators in guiding these investments. The VIX, which measures market volatility, has been rising, signaling uncertainty. At the same time, market breadth has been narrow, with gains driven by a few large-cap stocks while most others underperform. This environment suggests that investors should be cautious and consider reallocating some of their portfolios into more defensive sectors like infrastructure, real estate, and gold. By doing so, you can potentially mitigate some of the risks associated with an overvalued market while still positioning yourself for growth.
Exactly. And when you combine these investments with a broader strategy that includes hedging with volatility products, you create a more resilient portfolio. For instance, pairing infrastructure and real estate investments with a small allocation to volatility products like UVXY can help protect against sudden market downturns. Similarly, holding gold as a portion of your portfolio can serve as a hedge against inflation and currency devaluation, both of which are concerns given the current levels of national and corporate debt. The key is to create a balanced portfolio that's prepared for various market scenarios, from inflationary pressures to market corrections.
In summary, infrastructure, real estate, and gold are three sectors that offer robust investment opportunities in today's market. By carefully selecting your investments within these sectors and complementing them with volatility hedges, you can build a portfolio that's not only resilient, but also positioned for growth. Up next, we'll explore some defensive investment strategies that can further enhance your portfolio's ability to weather economic uncertainties. Stay with us.
As we move forward, it's important to discuss how you can protect your portfolio in uncertain times. With the market showing signs of overvaluation, rising volatility, and mixed sentiment, defensive investment strategies are becoming increasingly relevant. In this segment, we'll explore several strategies that can help you safeguard your investments while still allowing for growth opportunities.
One of the most effective defensive strategies is sector rotation. This involves shifting your investments into sectors that tend to perform well during economic downturns, such as utilities, healthcare, and consumer staples. These sectors provide essential goods and services, so they typically see less of a drop in demand during recessions. For example, utilities companies continue to generate revenue even in tough economic times, as people still need electricity and water. Similarly, healthcare is a sector that remains resilient, as medical needs don't diminish during downturns. By rotating into these sectors, you can reduce the volatility in your portfolio and maintain steady returns.
Another strategy to consider is investing in high-dividend stocks. Dividend-paying stocks can provide a steady income stream, which can be particularly valuable when market returns are low. Companies that pay dividends are often more established and financially stable, making them a safer bet in volatile markets. Look for companies with a strong history of dividend payments and a sustainable payout ratio. Dividend aristocrats, which are companies that have increased their dividends for at least 25 consecutive years, are a good place to start. These stocks not only offer income but also tend to hold up better during market corrections.
Bonds are another key component of a defensive investment strategy. While bonds might not offer the same high returns as stocks, they provide stability and can act as a counterbalance to the volatility in your equity investments. Government bonds, in particular, are considered safe haven assets, as they are backed by the full faith and credit of the issuing government. Corporate bonds can offer higher yields but come with more risk, so it's important to choose issuers with strong credit ratings. By including bonds in your portfolio, you can reduce overall risk and ensure a more stable income stream, especially in times of economic uncertainty.
Let's also talk about cash as a defensive asset. Holding a portion of your portfolio in cash or cash equivalents like money market funds can give you the flexibility to take advantage of opportunities as they arise. Cash provides liquidity, allowing you to quickly buy into the market during dips or reallocate your investments as conditions change. While cash won't earn much in the way of returns, it's a crucial component of a well-rounded defensive strategy, especially when market conditions are uncertain.
Lastly, consider incorporating a mix of these defensive strategies to create a diversified portfolio that can weather different market conditions. For instance, you might allocate a portion of your portfolio to high dividend stocks and bonds while keeping some cash on hand for flexibility. Additionally, you can use sector rotation to move into more defensive sectors as economic conditions shift. The goal is to build a portfolio that not only protects against downside risk, but also provides opportunities for growth, even in challenging times.
In summary, defensive investment strategies like sector rotation, high dividend stocks, bonds, and holding cash are all effective ways to safeguard your portfolio against volatility and economic downturns. By strategically incorporating these elements, you can create a more resilient portfolio that's well positioned to navigate whatever the market throws your way. Up next, we'll take a closer look at the infrastructure and real estate sectors, which are offering unique opportunities in today's market. Stay tuned.
Let's shift our focus now to two sectors that are often seen as pillars of stability: infrastructure and real estate. These sectors have been gaining attention not just for their resilience, but also for their potential to deliver steady returns in both good and challenging economic environments. With government spending on infrastructure likely to increase and ongoing demand for real estate, these areas present compelling opportunities for investors.
Starting with infrastructure, this sector is being driven by several key factors. The ongoing need for modernization of aging infrastructure, combined with government initiatives aimed at boosting economic growth, has created a strong tailwind for companies involved in this space. Whether it's roads, bridges, energy grids, or telecommunications networks, the demand for infrastructure development is growing. Investing in infrastructure-focused ETFs can provide broad exposure to this sector, allowing you to benefit from a diversified portfolio of companies involved in these essential projects.
Exactly. Infrastructure is often seen as a defensive play because it's tied to essential services that remain in demand regardless of economic cycles. Companies involved in infrastructure projects typically have long-term contracts and stable cash flows, which makes them less susceptible to market volatility. For instance, utilities companies that manage energy grids or water supply systems are indispensable, and their revenue streams are generally consistent. This makes infrastructure an attractive option for investors looking to add stability to their portfolios while still capturing growth.
Moving on to real estate, this sector offers a mix of income and growth opportunities, particularly through real estate investment trusts, or REITs. REITs allow investors to gain exposure to real estate without the need to directly purchase properties. They typically pay out a large portion of their earnings as dividends, providing a steady income stream. What's particularly interesting right now is the performance of REITs focused on commercial properties, especially those involved in warehousing and logistics. With the ongoing rise of e-commerce, there's a growing need for warehouse space, making this a sector with strong potential.
And it's not just commercial real estate that's worth considering. Residential real estate, particularly in urban areas, continues to be a solid investment, driven by population growth and urbanization trends. Even with fluctuations in the housing market, the long-term demand for residential properties in major cities remains strong. For those looking to diversify their real estate exposure, investing in a mix of commercial and residential REITs can provide a balanced portfolio that captures the strengths of both segments.
Another important aspect to consider when investing in real estate and infrastructure is the potential for these sectors to act as a hedge against inflation. As prices rise, the value of real assets like real estate and infrastructure often increases as well, making them a valuable addition to an inflation-resistant portfolio. This is particularly relevant in the current economic environment, where inflation concerns are rising due to high levels of government debt and ongoing stimulus measures. By including real assets in your portfolio, you can protect your purchasing power over the long term.
In summary, infrastructure and real estate are two sectors that offer both stability and growth potential. With strong underlying demand, government support, and their ability to act as a hedge against inflation, these sectors are well worth considering as part of a diversified investment strategy. Up next, we'll explore the role of gold and other safe haven assets in today's market. So stay with us. Now let's talk about gold and other safe haven assets, which have always played a crucial role in protecting wealth, especially during times of economic uncertainty. With market valuations running high, as indicated by the Buffett indicator and the Shiller P/E ratio, and rising volatility reflected in the VIX, investors are understandably looking for ways to hedge their portfolios against potential downturns. Gold, often referred to as a safe haven, is a popular choice for these situations.
That's right, Sophia. Gold has historically been a store of value, particularly in times of economic instability or inflation. Unlike fiat currencies, which can lose value due to inflation or other economic factors, gold tends to maintain its value over time. This makes it an attractive option for investors who are looking to preserve their wealth. There are several ways to invest in gold, including physical gold like coins or bars, gold ETFs like GLD, and gold mining stocks. Each option comes with its own risk and reward profile, so it's important to choose the one that aligns with your investment strategy.
In addition to gold, there are other safe haven assets that investors should consider. Silver, for example, is another precious metal that often performs well during periods of market volatility. It's also used in a variety of industrial applications, which adds to its demand. Then there are government bonds, particularly those issued by stable governments, which are considered low-risk investments. U.S. Treasury bonds, for instance, are backed by the full faith and credit of the U.S. government, making them one of the safest investments available. These bonds can provide a steady income stream while also acting as a hedge against market downturns.
Let's not forget about the role of currencies in a safe haven strategy. The US dollar, Swiss franc, and Japanese yen are often sought after during times of global instability because of the perceived safety of their respective economies. Investing in these currencies, or in currency-backed ETFs, can provide another layer of protection against market volatility. Additionally, some investors look to real assets like real estate or infrastructure, which we discussed earlier, as they can offer both income and capital appreciation while also serving as a hedge against inflation.
Exactly. And speaking of diversification, it's important to remember that a well-rounded portfolio often includes a mix of these safe haven assets. By spreading your investments across gold, silver, bonds, and safe haven currencies, you can reduce the overall risk of your portfolio. This is particularly important in today's market, where we're seeing significant valuation concerns and potential volatility on the horizon. A diversified approach can help you weather the storm and come out ahead when the markets stabilize.
To sum it up, gold and other safe haven assets play a vital role in any investment strategy, especially in uncertain times. Whether you're looking to preserve wealth, hedge against inflation, or simply reduce volatility in your portfolio, these assets can provide the stability and protection you need. And with the current economic indicators suggesting potential challenges ahead, now might be the right time to consider increasing your exposure to these safe haven investments. Up next, we'll delve into advanced volatility trading strategies that can further enhance your portfolio's resilience. Stay with us.
As we wrap up today's episode, let's dive into a more sophisticated area of volatility trading. Volatility products can be powerful tools in your investment arsenal, particularly when markets are uncertain and traditional strategies may not be enough to protect your portfolio. In this segment, we'll explore some advanced volatility trading strategies that can help you capitalize on market fluctuations while hedging against potential risks.
Volatility trading revolves around the concept of taking positions that benefit from changes in market volatility rather than just directional movements of the market. One of the most common instruments used for this purpose is the VIX, often referred to as the fear index. The VIX measures the market's expectation of volatility based on S&P 500 index options, and it tends to spike during times of market turmoil. By trading VIX futures, options, or ETFs like UVXY, you can directly profit from increases in volatility.
Exactly. One advanced strategy is volatility arbitrage, which involves taking positions in different volatility-related instruments to exploit price discrepancies. For example, you might simultaneously buy VIX futures while shorting a correlated ETF like SPY when you expect a divergence in their price movements. This strategy requires a deep understanding of how these instruments behave relative to each other, as well as close monitoring of market conditions. It's not for the faint of heart, but when executed correctly, it can yield substantial returns.
Another approach is to use VIX options to hedge against your other positions. Let's say you hold a portfolio of stocks that you believe in long-term but are concerned about short-term market volatility. You could buy VIX call options, which increase in value as market volatility rises. This can offset potential losses in your stock portfolio during turbulent times. Alternatively, if you're expecting a temporary spike in volatility but believe the market will eventually stabilize, you could sell short-term VIX call options and buy longer-term VIX calls, capturing the time decay on the short position while maintaining upside potential on the long position.
And then there's the strategy of trading volatility ETPs like the UVXY or SVXY. The UVXY, for example, is a leveraged ETF that provides exposure to short-term VIX futures, amplifying the movements of the VIX. This makes it a potent tool for traders looking to capitalize on sharp spikes in volatility. However, it's crucial to remember that these products are designed for short-term trading. Due to the effects of daily rebalancing, holding them for extended periods can lead to significant losses, even if the market moves in your favor. This makes it essential to have a clear exit strategy when trading these instruments.
For those looking to take a more cautious approach, selling options on volatility products can be a way to generate income in stable markets. For example, you could sell covered calls on VIX ETFs when you expect volatility to decrease, earning the premium while still holding the underlying asset. This strategy works well in environments where you believe volatility is likely to mean revert after a spike. Just like with any option strategy, understanding the Greeks, especially theta, which measures time decay, is crucial for managing risk and optimizing returns.
In summary, advanced volatility trading strategies offer a range of opportunities to profit from market fluctuations while protecting your portfolio from unexpected swings. Whether you're using VIX options, engaging in volatility arbitrage, or trading leveraged ETFs like UVXY, the key is to stay informed, manage your risk carefully, and always have a clear plan for entry and exit. Volatility products can be incredibly powerful, but they require a disciplined approach and a deep understanding of market dynamics.
That wraps up our deep dive into advanced volatility trading. We've covered a lot of ground in today's episode, from small-cap stock picks and sector-specific strategies to defensive investments, infrastructure, real estate, gold, and now, volatility trading. Each of these topics is crucial for building a resilient and profitable portfolio in 2024. As always, the key to success in the markets is staying informed, being flexible, and executing your strategies with precision. We hope you found today's episode insightful and that it provides you with the tools you need to make smart financial decisions.
As we bring today's episode to a close, let's recap some of the key takeaways that can help you navigate the financial landscape in 2024. We've covered a wide range of topics, from actionable stock picks and investment opportunities in infrastructure, real estate, and gold, to advanced strategies for trading volatility and protecting your portfolio with defensive investments. Each of these areas offers unique opportunities and challenges, but with the right strategies, you can position yourself for success in the months ahead.
That's right. Whether you're looking to capitalize on small-cap stocks like Innodata Incorporated, INOD, and California Nanotechnologies Corp, CANOF, CNO, or seeking stability through investments in infrastructure and real estate, the key is to stay informed and agile. The market is always evolving, and having a diversified, well-thought-out strategy will be your best defense against uncertainty. Remember, the insights and strategies we've discussed today are meant to give you the tools you need to make informed decisions that align with your financial goals.
We also can't stress enough the importance of monitoring market indicators. Understanding the signals sent by tools like the VIX, yield curve, and the Buffett indicator can help you anticipate market movements and adjust your strategies accordingly. As we've discussed, integrating defensive strategies and safe haven assets like gold into your portfolio can provide a crucial buffer during volatile times.
Exactly. And if you're looking to deepen your understanding of these strategies or want to stay up to date with the latest market trends, make sure you're subscribed to Finance Frontier AI. We'll continue to bring you timely insights, expert analysis, and actionable strategies to help you stay ahead in the markets.
Before we go, we'd like to remind you to follow us on Twitter for live updates and exclusive content. We regularly post insights on new trades, market movements, and other financial opportunities that you won't want to miss. And if you found today's episode valuable, please share it with your friends and colleagues. Your support helps us reach more listeners and grow our community of finance and AI enthusiasts.
Thank you for joining us today. We hope you're leaving with new insights and strategies that you can put into action. Stay tuned for our next episode, where we'll continue to explore the intersections of finance, technology, and innovation. Until then, stay informed, stay strategic, and keep making money with Finance Frontier AI.
And before we sign off, please note that the information provided in this episode is for informational purposes only and does not constitute financial advice. Always do your own research or consult with a professional before making any investment decisions. Sources for the information discussed today include market analysis, news reports, and financial data from investing.com and Google News. Music used in this episode includes Crystal by Vibe Tracks, provided under the YouTube Audio Library license. This track is available for use in your videos without the need for attribution.